Hi, it's me again, Julian Sims. This is the second of the what we've called the primer videos, which are the basic concepts of accounting and finance and governance to try to bring everybody up to the same level. So in the first session, what I did was I talked about how we record transactions and how those records can then be consolidated into traditional financial accounting reports or financial reporting. One of the key things to remember is that while financial accounting is for external purposes and management accounting is for internal purposes, financial accounting is regulated by governments. It's regulated by general accounting principles or international financial reporting standards. And this is because we want to make sure that organizations are managed honestly. And over the period of years from the 1700s onwards, as private industry was invented, so there was a separation between those people who invested in a company and those people who ran it. And that's called the principal-agent problem. The principals are the people who invest in a company and the agents are people who run it. And over time, obviously, we realize that there are many different types of company. There's private companies which are limited companies. There are some which are limited by guarantee. There are for-profit companies. There are not-for-profit companies, there are mutuals and cooperatives, and of course there are government agencies. And all of these different types of organisations need to manage their resources and report honestly what's going on. And we still have the principal-agent problem even with a government. So we have the principals, which are in a way the taxpayer and the ordinary people, and we have the agents, who are the people managing that organisation. So over the years, people have devised all kinds of different ways of reporting what's going on inside an organization, and often been a little bit creative, shall we say, about how they report what's going on. They try to paint it and make it all look a bit rosier than perhaps it really is. And in some cases, a lot rosier than it actually really was. If we think about Enron and WorldCom and things like that, you know, there have been a great many real criminal activity and fraud going on. So what we've done is we've honed the rules around how transactions are reported and resource management is reported. We've tried to hone those rules to make it less likely that there's fraud, less likely that there's criminal activity, and we've tried to make the reports better and better. And so the international financial reporting standards are created by international bodies into which governments and the professional accounting organizations have their input, and the output are a set of regulations which we hope a set of principles which make it a bit more reliable so that we can trust the figures a bit more than we used to. So to help me today, I'm going to use slides. These slides are associated with a particular chapter in one of the MBA textbooks, which is Bamber and Parry. This is from the second edition. And I'm going to quickly go through these slides. Some of them I'm going to dwell on more than others, but they're really there so that you can get an idea of how we take those T accounts, which of course today would be on spreadsheets and in computer systems, and consolidate them into reports. So here we go. Today, the learning outcomes are: describe the key elements of an accounting system, identify the different types of accounting adjustments, assess the impact of accounting adjustments on results, and then prepare the basic primary financial statements. So, what accounting systems record and how they're recorded? We have cash-based accounting. So earlier in the previous session, I was talking about how we treat cash. but there are other things. There are accruals and there are prepayments. So if, for example, I use electricity this month in December, but I'm not going to pay for it till the bill arrives in January, that's an accrual. I'm accruing a liability for the electricity used. On the other hand, if I pay my insurance this month in December, but it covers for a year, then I've prepaid for part of next year's insurance. So we have accruals and prepayments, which are accounting adjustments. We've got the impact of the accounting adjustments on the profit and loss and on the balance sheet. We've got practical issues of adjustment, so dealing with tangible and non-tangible and tangible non-current assets. Let's have a look at the financial statements. The first one is the statement of comprehensive income. When I was younger, that used to be called the profit and loss account, but of course it applies to organizations which don't make a profit, government agencies, charities, NGOs, and so forth. But the statement of comprehensive income shows how much profit the business has made during a specific period of time, normally a year, but usually for internal purposes we have a profit and loss account, could be weekly or monthly or quarterly, so that people within the organization know how things are going and can take remedial action quickly rather than waiting for a year. But under regulation, under international financial reporting standards and under the laws in each individual country, an organization must produce a profit and loss every year. Okay? Certain headings are important. We've got gross profit. So the gross profit is the income less the costs directly related to whatever that organization does. Operating profit is the profit before interest and tax. So that's called PBIT, profit before interest and tax. That's a gross profit less the selling, administration and distribution expenses. So we've got gross profit, the revenue, less the cost of goods and a cost related to selling those goods. Then we've got the operating profit, which is the gross profit less the expenses. Then we've got the profit for the period or net profit, which is operating profit less finance costs, income and taxation. And then comprehensive income, profit after deducting all the realized and unrealized gains and losses. That's the bottom line. And it's actually a list of lines, and that's why the term the bottom line comes in. The bottom line is after everything else is taken into consideration. That's the bottom line. That's the profit, the comprehensive income. So here we can see a statement of comprehensive income as an example. At the top we've got revenue, cost of sales, gross profit. Then we've got the operating expenses, things like heating and lighting, rent and rates, running motor vehicles, wages, insurance, postage, packing, stationery, and so forth. Depreciation, which I'll get onto in a minute, amortization, and we've got the operating profit. Then we've got finance income, because we may have invested, we may have spare cash that we put into bonds or whatever, or interest-bearing bank accounts, and so that's the finance income. Then we've got the finance costs, paying off loans and things like that, the interest on loans. Then we've got the profit before taxation, then profit for the year, and you can see that's the bottom line. That is the bottom line on the account, profit for the year. Okay, the statement of financial position. That, when I was younger, used to be called the balance sheet. It's a snapshot of the place or the position of that organization in financial terms at a particular point in time. It's comparable, it says here, comparable to a financial photograph, okay? The golden rule is every debit entry in the ledger must be matched by a corresponding credit. So I talked about that in the first session. We have the debits and credits and that balances. And that comes through into the balance sheet. So we've got assets minus liabilities equals capital or shareholders' funds. So the whole principle of balancing is why it's called a balance sheet. We have the debits and the credits, we've got the assets and the liabilities, and the statement of financial position is where we consolidate all of that into one report. The key headings are assets. So we've got non-current assets or fixed assets such as property, plant, equipment, machinery. We've got goodwill, which is an intangible asset. Then we've got current assets such as inventories, trade receivables, cash and cash equivalents. Then we've got liabilities. So we've got long-term liabilities like loans, and we've got current liabilities, which are like what we owe to our suppliers. Bank overdraft is a current liability. And then we have equity and reserves. So we've got share capital, retained earnings, and other reserves like share premium and revaluation. And part of this part here is going to be non-distributable. There are funds which by law we cannot distribute. Things like the share premium account and the revaluation account, we can't distribute that as dividends. And so if we have, say, buildings which we own and they're in this account as non-current assets, so property up at the top, and we've been showing it at a certain value, and we think, well, actually, a few years have gone by, those buildings are now worth more, so we revalue them. That revaluation shows that there's a greater value in the organization, and that comes into a revaluation reserve. We're not allowed to spend that. It's not real money. It's what the building is worth. It's not cash, so we're not allowed to spend it. This is a statement of financial position from Morrisons from 2013. I'm sure you can't read it. I can barely read it on this screen. But what it's here is just to show you the layout. So we've got assets at the top, non-current assets, current assets, liabilities, current liabilities, non-current liabilities, and then net assets at the bottom. The net assets is all of these assets minus all of these liabilities, which give us our net assets here, which is 5,230,000, okay? Or million, sorry. And then here we've got net assets, we've got shareholders' equity, we've got called up share capital, share premium, which is not distributable. So if we have a new release of shares and they're £1 shares, but we're selling them for £2 each, the extra pound is called the share premium. That is not distributable. That is a ring-fenced part of the accounts. So we have called up share capital, share premium, capital redemption reserve, and then we've got retained earnings. Okay, so retained earnings are distributable. And then at the bottom we've got total equity attributable to the owners of the company, 5,230, which matches the 5,230 there. So we have a balance, which is why it used to be called a balance sheet, because it must balance. So all of these assets and liabilities netted out come to these shareholders' equity here, which is netted out. Okay? Then we've got statement of cash flows. The statement of comprehensive income and financial position are based on the accruals concept, which means that we are accounting for things we haven't paid for yet, but we account for them at the time that we're using them. We're also accounting for things we've prepaid that we haven't used yet, and so they will be accounted for at the time we use them. But the cash flow statement is only interested in cash, called the lifeblood of the organization, because that's how we pay our bills, it's how we pay our wages. If we don't have cash, we're in trouble. And we can see that recently when House of Fraser ran into trouble and the creditors, the suppliers, stopped supplying the company with supplies for its shops and said, well, we don't think that House of Fraser has the cash to pay us, so we're not going to supply you anymore, until it was rescued by somebody. So it's all about cash and the movement of cash, whether we've earned or spent cash and cash equivalents during that period of time. So the focus is cash. cash inflows versus cash outflows, and it's divided between operating, investing, and financing. Operating is obviously the most important thing because this is the function of this particular organization. And here we can see when preparing cash flows, we see that an increase in the current cash and the current assets, like inventories, will lead to a decrease in cash. So here we've got cash. We start off with cash. Then that goes to payables, offset amounts owed by customers with amounts owed to suppliers. We use the cash to purchase raw materials in a traditional manufacturing sense. We convert the raw materials into finished goods, and then the finished goods we sell on credit terms. We don't necessarily get cash for it, so that generates receivables or debtors. Debtors are people who owe us money. We convert those owed by customers into cash, and this is the cash flow cycle that goes through the organization. Now this has raw materials converted into finished goods, so the concept is kind of a manufacturing one, which is how all this started back in the 17 and 1800s, but it is just as applicable to a service organization or to a government agency. We still have this cash flow cycle. To prepare the set of financial statements, we've got an example from the textbook here called Mobius. So on day one, we transfer £1,000 from our personal bank account to a bank account held in the name of Mobius Inc. So Mobius Inc. or Mobius Limited would be a separate entity. How does this affect the accounting equation? Well, we've got assets 1,000, liabilities 0, shareholders' funds 1,000. Okay. On day two, we borrow 500 from a friend, provide further financing. So here now we've got an additional 500, which is a liability because it's a loan. So we've got assets of 1,500 in cash, we've got a liability of 500, and we've got shareholders' capital of 1,000. On day five, we use raw materials to produce 30 units of finished goods. On day six, half of these are sold for $50 a unit. Cash are received immediately for 5 of them, and the rest are on 10-day credit terms. And so this is how it looks. Day 5, we've got assets 1,900 now, liabilities 900, and shareholders' funds 1,000. Okay? If we're preparing a set of financial statements, solution for day 6, we've got the goods which cost 400 were transformed into 30 saleable units of inventory, of which half were sold for £50 a unit. 5 were bought and paid for immediately. 10 have been sold under 10-day credit terms. So the changes to the accounting are revenue generated 15 units times 500 is 750, of which cash collected was 5 times 50 equals 250, and the amount owed from customers was 10 units times 50, which is 500. So the amount of inventory used to generate those sales was 200. Oops. So here we've got the assets, liabilities, and capital. Opening balance 1,900 for assets, 900 for liabilities, 1,000 for capital. Then we've got cash collected, owed by customers, inventories consumed, closing balance 2,450. And then here we've got opening balance 1,000, contribution to retained earnings, revenue 750, cost of sales 200. And so the 900 and the 1,550 will balance to 2,450. Right, moving quickly on. The cost of sales working in the statement of financial position applies to accruals concept to match the expenses to the period in which it's occurred. Okay, so the cost of sales is sometimes referred to as a cost of goods sold, and the matching units of the product sold to the direct cost of purchasing those units. The basic working is like this: opening inventories, purchases, closing inventories. So for Mobius, we've got these day 8, 9, 10, 11, 12, 13, 14. Business acquired raw materials valued at 800. Invoices need to be paid within 10 days. Raw materials converted into 60 units of finished goods. Company received a utility bill for 200, which is paid immediately out of cash. We assume the charge relates exclusively to this period. Mobius sold 35 units of inventories for $60 each. Cash was received for 20 of these units. The remainder were offered to customers on 10-day credit terms. We bought a printer scanner for 100. We bought some stationery, including paper and envelopes, for 50. We got 500 from customers who'd bought goods on credit terms. Day 14, amounts invoiced by suppliers for the week 1 of 400 were paid. And then we paid a web designer $750 to develop an online presence for the business. Absolute bargain, I think. And here we've got the assets, current assets, liabilities, net assets, and shareholders' capital. This all reflects all of these things which we've just gone through. That is the statement of financial position, or balance sheet, because the 2,183.33 there balances the 2,183.33 there. Then we have the profit and loss. So we've got the revenue coming in. We've got the cost of sales, which leaves us the gross profit. Then we've got the expenses here. And then we have the profit before interest and tax there. So some of the rules. Historic cost accounting, current cost accounting, mixed measurement model, money measurement concept, and business entity concept. These are the principles which have been developed over the decades, the centuries, in order to try to present a fair and honest picture of what's going inside an organization. So the fundamental concepts are accruals concept, going concern, prudence, disaggregation, and materiality. Let's go through those very quickly. Accruals. If we pay for something in the future that we're using now, we are accruing that liability. So if we use our electricity today, but we don't get the electricity bill until next month, we are accruing it. But because of the matching concept, we account for it in our accounts now, because now is when we're using it. Going concern, we assume that the organization is not going to go bust today, because if it were, then we would value things very differently. So we assume that it's going to keep going for about a year. Neutrality, okay. All of this has subjective viewpoints in it, and we try to be as detached as possible, and we try to be as objective as possible, which is why we have external auditors who are supposed to come in and give us a very objective, neutral view of what's going on. Disaggregation means that we account for all of the different components. We don't say, oh, here's the profit, here's the loss, this is the assets, this is the liabilities. We try to itemize it, because then outside people can look at that and compare it to similar organizations and try to get a sense of how fair and honest it's been. Materiality says, okay, yes, we're going to itemize things, but I'm not going to make an accounting entry for every stamp that we lick and stick on an envelope. We're going to say, is it a reasonable sized activity? We also have non-current assets. We have something called depreciation, which is how we account for using up the physical life of an asset. If we buy a machine that we know is going to last for 10 years, at the end of year one, we've used 1 year's worth of that machine. If that machine cost £1 million and at the end of year 1 we've used 1/10 of its useful life, then we should depreciate its value by $1 million. Because if we were to sell it, we would probably only get 9 million for it, because it's a 1-year-old machine and 1 year of its life has been consumed. And depreciation is a means of trying to account for the consumption of life of a fixed asset. So we have an example here from the book where we have a printer scanner. We say it's going to last for 20 months. Computer maybe lasts for 40 months, but we've got a friend who'll buy it for $100 at the end of that. And so we can say that the economic life of the printer scanner is 20 months. Therefore, at the end of every month, we should reduce that value. I'm sorry, there's a typo here. That should be 20 months, not years. The depreciation charge gets netted off against the carrying value, so that when we state what the value of the organisation is, we cannot claim the full value of that scanner because we've consumed some of its life. If we have a machine which we spent £1 million on, at the end of the first year we can't say, oh, we've got a £10 million machine, because we've consumed 1/10 of that value. So we have to reduce that, and in the statement of financial position, in the balance sheet, we say we've consumed that value and we only show it at the net book value. It's not necessarily the real value, because if we were to sell that printer scanner, who's going to come along and buy it and say, yeah, I'll pay $95 for a month-old printer scanner? They'll say, I'll pay $100 and buy a new one. And so you probably couldn't actually sell it for that, but at least you're making an attempt to account for the consumption of value. And that's why it's called net book value. And so over time, we depreciate the value of the printer scanner. The same thing with the computer. And if the computer's only good for 40 months, and so at the end of each month, we reduce it by $10. If we bought a new motor vehicle, we would have to account for that. Here we've got a motor vehicle that costs $19,500, delivery charge $500. We've got a matte black paint job for $1,000, convertible roof for $2,000, tank of petrol $150, road tax $200, total $23,350. Okay. If we take out a 10% loan for the whole amount, the interest paid is quarterly in arrears. So now we've got a prepayment. The principal capital amount borrowed is due to be repaid in full in 5 years' time. So how do we account for that? According to International Accounting Standard 16, that tells us how we account for it. And so there are certain rules there. So the cost of bringing that asset into production, into location. So we buy that van and we have it delivered to us. Those are all allowable costs, okay? And that's all allowed in the value of that vehicle. But there are other things which aren't. There are other things which are expenses, not assets and liabilities. So here we can see black paint job, convertible roof function, tank of petrol and the road tax. These are all expenses. These are things which do not have a long value. They're not tangible goods with an enduring value. So they're expenses. Then we have to depreciate it. We say it's only good for 5 years. And so we can say every year we have to account for the consumption of asset value of that van. The tangible non-current assets, we have a bank loan to finance the acquisition. So that has to be shown in there. And the interest that we pay is an expense. The principal that we pay off is a reduction in that liability. Tangible non-current assets, so we've got the summary of the accounting entries required in here, so that we have to accrue for the interest which is unpaid at the end of the month. So we have to look at remeasurement and revalues. So if we have some property we believed has increased in value, as I said earlier, We could revalue those assets and claim them in our financial position. So an increase in the value of non-current assets, reduced associated accumulated depreciation to nil, and introduce into the revaluation reserve the new value of that asset. If we dispose of our non-current assets, so if we sold our van, then we would write off the written down value or book value and replace it with what we actually got for it. If we got more for it than we were had accounted for, then we would show that as a profit. If we got less for it, we would show that as a loss. Because as we depreciate, it's only an estimate. We don't know for sure exactly what the value of that printer, that scanner, or that van is. We are making an attempt at an honest, slightly subjective view of how we're consuming that value. We can show depreciation in two ways: reducing balance, which is possibly more realistic. My car is 19 years old, it's got 140,000 miles on the clock. I'm sure that this year it's not worth much different from what it was worth last year. But if a new car is driven out of the showroom, it drops in value very quickly to start with. So this is probably a more accurate depiction of what the value of an asset is as it declines over time. But for ease of use, we could also just put a straight line through it, and so that we have exactly the same depreciation every year. This is very frequently used, not because it's more accurate, but because it's easy. And we know that depreciation is only an estimate of the decline in asset value. So, summarizing here, bringing this all to a close. We record accounting information. We've got sales invoices, the sales day book, which used to be an actual physical book, which goes into the nominal ledger, and the sales day book goes into the sales ledger. We've got cash inflows and outflows, which goes into a cash book. We've got receipts into the sales ledger, but also into the nominal ledger. We've got payments, which goes into the nominal ledger, also into the purchase ledger. So we've got purchase invoices, purchase day book, purchase ledger. Nominal ledger, we've got assets, expenses, losses, liabilities, income, profits, trial balance, and the financial statements at the end. So this is a graphical representation, a diagrammatic representation of what happens as we consolidate all of the recordings of those transactions into our final accounts. There will be some period end adjustments so that we do have a trial balance. That's because we actually aren't sure that it is going to balance, and we go through and we try to find out where it isn't balancing. There will also be some things which have not yet been recorded, which we know have gone on, and so those are period end adjustments. We've got the statement of cash flows, so we have operating, investing, and financing, and that reconciles with the opening cash balances and the closing from our final balance sheet or statement of financial position. Because it's a simple business, this example is terribly oversimplified, and so it's relatively straightforward to show the cash flow. But because we're asked to prepare a statement of cash flow, we're given the balancing figure, the closing balance of the cash and cash equivalents. And sometimes this might be a combination of balances, so petty cash, bank overdraft, short-term cash, and cash equivalents. But ultimately, it makes the thing easier to complete. But this is to show where the cash has gone. And we do this usually on a weekly, monthly, quarterly basis so that we can take remedial action quickly when we see we're running out of cash. The same thing with the profit and loss. If we see that losses are mounting up much quicker than we anticipated. And so we have, although financial accounting is for external purposes, we do use it internally as well to keep track of things. Here's a statement of cash flows, cash generated from operating activities, interest paid, dividends paid, net cash flow from operating activities. Then we've got cash flows from investing, assets purchased, assets sold, net cash flow from investing activities, then cash flow from financing activities, issue of shares, receipt of loan, repayment of loan, and then net cash flows from financing activities, and then the net cash inflow and outflow from all activities, opening net cash, closing net cash. So that anyone looking at this, it's segmented into sensible areas so that somebody looking at this can get an idea of what's going on inside the organization. They can compare it with other similar organizations to see if that makes sense, and people can get an idea of what's going on. So what have we done? We've looked at how, in the first session, how we record each transaction. And in this session, we've looked at how all of these transactions are consolidated into our three primary reports. Our balance sheet, which is a snapshot of the value of the organization at a given point in time. The profit and loss, which is recording all of the activities, even in a not-for-profit organization or a governmental organization, recording all of the activities. And then we've got the cash flow statement, which shows where we are with cash and our ability to pay our bills. And that's it for this one. Okay, thanks.